Hey everybody, good weekend. Here is your market minute for Sunday, the 24th of September. Okay, we had a big week in the S&P 500 and we finally got some resolution from this triangle pattern that we were in. We talked about this at length for the past few weeks, that we were either going to get a break to the upside, which was going to favor the longer term trend, or we were going to see a break to the downside first. And that is certainly what happened in the last 3 or 4 days of this week, generally triggered by hawkish comments from the Fed on Wednesday. So now we are in a position for the S&P where there's basically two scenarios that are going to play out from here. Now, let me go over the least likely scenario first, which is scenario number one, which is that we have a double bottom happening right now. So this is a double bottom with an undercut. And in the past, this has been responsible for some very, very strong short covering scenarios, especially if the right piece of information hits the market at exactly the right time, because everybody is bearish right now. We do have a confirmation of a change in polarity to a downtrend now on the weekly chart. Everything is bearish. We have implied volatility rising over the past couple of weeks. We've got negative news no matter which way you go. Things are just bearish right now. And this is also one of the most bearish weeks, or the most bearish periods of the entire year, is the last 2 weeks in September. So everything is playing out really for the herd right now. So this is feasible that we could get some type of information that comes along on Monday, which causes a great scramble to close all of those newly opened short positions and cause a lot of demand to come into the market. And to go along with that, we have a lot of energy at all the larger time frames to power a move higher from here. We also have exhaustion to the downside, which would also technically support the price going higher. So scenario number one, and this has to happen, I would say, Monday or Tuesday at the very latest. And we can't see additional downside movement from here. This basically has to hold water where it is, and then immediately, if not sooner, start to trade above 43.50 with some big volume and a big close at the end of the day, which could kind of look like this. We actually could go a little bit lower during the day, but we have to close near the highs of the day. So a hammer candlestick down in this area would be a great kickoff towards scenario number one, which would be short covering. This is probably less likely to happen than scenario number two. Scenario number two says that we have started a weekly trend to the downside. And so these are powerful. And rule number one says that larger time frames dominate the trend. Now we still have a monthly uptrend here, but a weekly downtrend, even if it just creates a monthly pullback, can be very, very powerful. I think you can see some of the areas that we can identify as potential landing zones. 4,200, which is the swing test breakout from June, is an obvious candidate. 4,300 I gave some thought to, but I don't think 4,300 by itself is going to hold just because of this little pivot over here. I think also what we have is the green line, which is the 200-day moving average, which is in confluence with that swing test at 4,200. That's also in play. Now, even though we have exhaustion, we don't have true exhaustion until, especially with the amount of energy that we have available at the weekly chart, we could still stretch down to 4,200 pretty quickly. And we don't really even have RSI oversold yet. We're at an RSI level of about 32, 33. So probably getting a level down here under 30 is going to require a little bit more of a stretch. And it's not surprising to see that the last time we were actually at an RSI value less than 30 was in the late September timeframe last year, which was the bottom of this bear market so far. Now, the last thing I want to bring to your attention is on scenario number two, if we do fall from here, this is the volume profile for the S&P 500. And we're seeing a lot of volume transacted at these prices, and it pretty much falls off like this because these types of movements do not create support and resistance. When you have a breakout like this, where you make up a whole lot of ground in a very short period of time, it does not create volume transacted at those prices. So we basically have a whole vacuum down in this area. And support does not come in until just starting around 4,200, but the point of control is actually down here at about 4,120. So this could go actually quite a bit lower than that, lower than the swing test at 4,200, lower than the moving average at 4,200, all the way down here to the point of control. So this to me is the last line of defense for the bulls. So we could get a move all the way down into the volume profile low of 4120. Now, if that happens, don't expect to see a V bottom off of here. I think if we do get down to this level, it may be some starts and stops. We could take a couple of swings to get down in this level, because after all, that would be the C wave of this entire corrective pattern. So it may take a while before this bottoms out, maybe sometime in October before this bottoms out. I do expect an upside resolution from this, at least for a while, because we will be by that time very, very oversold and looking for some type of fourth quarter move, which very reliably happens. Even again, it's up to a lower high. So we're just going to take this one swing at a time. Really, all we care about is scenario number one happening on this swing, which is a double bottom undercut, hammer candlestick, boom, short covering, or scenario number two, we unfurl this trend to the downside. It comes down to at least 4,200 and maybe as far as 4,120. That's it for today's Market Minute. We'll see you on the next one. Thanks for listening.